Hey guys, it's Fabio, and in this video I'm going to be showing you the exact difference between a trade hitting your stop loss and a trade hitting your TP. We're going to be running through supply and demand, liquidity, market structure, showing you exactly how to enter and exit a position and how to identify high probability areas of supply and demand in combination with liquidity. So with that said, let's dive in, enjoy the video, make sure to leave a like and subscribe, and let's dive straight in. Alright, so we're here on the charts on pound dollar on the daily time frame, and I'm going to run you through every single confluence so that at the end of this video you understand exactly how to enter these kind of positions yourself. So make sure to take notes and let's dive straight in. So the very first thing that you want to do is understand what the overall market structure is doing. So what I have here is a bullish market creating higher highs, higher high, higher high, higher low, and what we then see is a new lower low created, and that we see a bearish market structure shift. So we have a bearish break of structure. So to me, this now indicates, okay, Fabio, on the daily time frame, GU is now bearish. But the daily time frame obviously is a swing. It can vary from day to day. Sometimes you have a bullish candle, sometimes you have a bearish candle. So how do you understand on the day itself if you're looking for a long or a short? Well, for that I use this little trick called fractal structure. And fractal structure is nothing more than looking at the structure of individual candlesticks. So what I'm going to do is I'm going to apply it here to the individual candlesticks of the most recent days. And this for me is my low, this is my high, this is my higher low, this is my higher high, and then this is my lower low. So what we see here is a break of structure in towards the highs. However, shortly after we form a break of structure in towards the lows again. So very simply said, this is the push up in towards this high. Then you see here we fail to break the high, so this is considered a pullback, another push up, and then a break of structure down. So now on the pullback, we could potentially see another drop down lower. So at this point in time, I understand here with my daily bias that the swing structure is bearish, but that my fractal structure creating my immediate bias for the day itself is bearish as well. Therefore, we can identify this as our area of supply, because this is the buy up for the sell down, which caused a break here on the daily time frame. And I'm now happy to go into the lower time frame and identify that potential short. So now that we're on the 4-hour time frame, again, we use the exact same confluences. So again, we saw a break of structure down. However, here we saw a break of structure up. So this means that as opposed to the daily time frame, the 4-hour time frame is bullish, and you would essentially expect a new push in towards the highs. However, the major difference is, once again, where are you trading? And this straight away is going to be your second piece of confluence, which is called the PVD. And the PVD is very simply said premium versus discount. So everything above the 0.5 fib is your premium, and inside premium you're always happy to sell. Everything below the 0.5 fib is your discount, and you're only happy to look for buys. So we're currently trading inside premium, and therefore we're happy to look for a sell. Furthermore, what we have here is again bearish fractal structure, because what we saw on individual candlesticks was a bearish market structure shift. Again, this is the low that broke this high, and as you can see, based on the individual candlesticks, we're now bearish and we're happy to look for another short. If we look again at the fractal structure as well and draw in the PVD tool, you can also see that we make a beautiful pullback in towards that 0.5 fib. And if we were to then identify supply and demand, we can very clearly see that supply over here is currently in control. So this is ultimately your buy up for the sell if we were to refine it to this candlestick over here. Or if we refine it to the imbalance candle, then you can also see this is the imbalance candle that broke structure, and therefore we're happy to look for a short position. So again, the 4-hour time frame, very clear. We're looking for a potential short in towards the downside, and all the confluences are there. Now, in order to identify the entry itself, go down in towards the 1-hour time frame, and on the 1-hour time frame, again, we applied the exact same confluences. Once again, we can very clearly see that we had a bullish market structure shift over here. However, we then flipped bearish. So this is your bearish market structure break. And at this point in time, this is therefore your swing high, and this over here is your swing low. If we draw in the premium versus discount, we can very clearly see that the market pulls up into premium, and straight away it starts reacting. Therefore, I'm happy to look for a potential short position. Next, we again identify our area of supply. So what we have over here is the buy up before the strong sell down that once again caused a break of structure. Therefore, this for me is a valid area of supply. Most traders would identify this as their valid area of supply. However, what you need to understand is that this supply zone is just internal liquidity to then fuel the real move in towards the downside. This is the initial reaction to your area of supply. Straight away, this is going to be the trick between identifying a profitable trade and a trade that is not profitable. That is that when you have an area of supply, you always want to identify the initial reaction reaction to that supply zone, because 9 out of 10 times that initial reaction is going to be a fake reaction. We're going to come back up, grab liquidity above that high, and then the real push will occur in towards the downside. So what we have here is, again, we have premium pricing, we have valid supply, we have bearish market structure, and now we also have liquidity. So at this point in time, the very last thing that rests to do is look for our valid entry model. So in order to identify the valid entry model, we need to look again for liquidity combined with a bearish market structure shift. So after grabbing liquidity above this high, what I identify here on the individual candlesticks is that we have a bearish market structure shift. What we see over here, again, remember, this is the exact same way that we did on the daily and the 4 hour, is that the market comes into that liquidity high. So we see the push up in towards this high, we see a pullback in towards this low, we see a push up in towards this high, and then we see a push in towards this low over here. Now what I'm looking for is a pullback in towards that freshly area of supply, which was just created, and then we're happy to look for that short. So what we see is that we actually already tapped into that supply zone. So that would have been the valid entry, because you place your entry on top of the supply zone with your stop loss always above it. This is a valid area of supply because it was formed by grabbing liquidity above this high over here. Straight away, this is also going to be the difference between you hitting a TP and not a stop loss. Most traders would identify this as their supply zone, and then they just simply sell on top of that supply zone. But we understand you always need to wait for bearish confirmation. So what we have here, by grabbing liquidity above the high and then seeing that bearish change of character, which I just explained, we can now look for a valid short, and you want to then always target equal lows, because equal lows is where the liquidity lies, for a 1 to 3 risk to reward. So as you can see, if we just adjust the stop loss slightly, we have a 1 to 3 risk to reward. We get tagged in, or we would have been tagged in if we would place our limit after breaking structure over here. As you can see, we get tagged in, and then the real push in towards the downside will occur, and that is how you can identify a profitable trade instead of hitting your stop loss.